Welcome to the abbreviated version of the daily video update. I appreciate a lot of the feedback that many of you are giving, that you still like the shorter videos and you're getting something out of them. I also appreciate that a lot of you like the longer videos, and that's great. And I'll get back to doing those as soon as I can. I just have a lot of different things going on right now, both from a technological standpoint and because of my current living situation, that's really making it a challenge to do the full-blown videos right now. But I'm still watching everything very, very closely. And you can see the chart in front of you. This is what I watch during the day, and I have some other charts that I'll show you. So what I have to say about the market is, okay, according to what we've used for many, many years, we are now in a recession. The GDP came out and it was negative. Now, there'll be other revisions to this report as we go along, and there'll be even revisions months down the road looking back on what we're going through right now. They're constantly going back and forth with things. There's a debate going on right now. Are we in a recession? Are we not in a recession? Even though the numbers say that we are. My personal suggestion would be follow the charts, because if you go with what people just say, you can take a word and change it into anything, whether it fits the narrative that you're trying to put forth or try to change things around. That's why I like to look at the charts, because there's no ambiguity there. Yes, it takes some ability to be able to interpret the charts and understand what they're actually telling us, and then look at this chart in the context of other charts. But that's the skill that I've tried to develop for myself. It's what I'm trying to portray to you, and it's what I'm trying to develop the students that are in my program, the ability to have that skill so that you can make your own decisions, not just go off what somebody says and says, well, this guy says it, so I'm going to do it. No, look at this information, take all the information in that you can, and then reach your own conclusion. And you're not always going to be right, but you're not always going to be wrong either. And then over a period of time, you will be able to develop a skill that you yourself have that allows you to have more confidence as you're going forth developing your investment program. But whether you agree or disagree, irregardless of where you, and irregardless is not a word, regardless of where you stand politically, I wouldn't let that come into the picture, whether it goes against what you like or for what you like. Look at the charts and reach that conclusion objectively. Now, other areas in your life, all the different social issues going on, fine. But that's outside of what we're looking at right here and what we're trying to analyze as far as what's happening in the stock market and where are things going from here. All right, I don't know. I just felt I needed to say that because I'm watching a lot of things and reading some things, and people are saying, well, yeah, it says we're in a recession, but we're going to go ahead and change the definition of what a recession is. Well, they're doing that not necessarily to benefit you, they're doing that to benefit them so they can justify either doing something or not doing something. So, anyway, here's the chart, the daily chart. I haven't shown this in a few days, but going into Thursday's session, it looked like we were going to have a little bit of a lower open, and that should not have been a surprise. The futures were fairly strong during the night. The dollar was kind of going up and down. Then we had the GDP report come out, and since it did suggest now on an economic basis that we are in a recession, that took the futures lower before the open, and we had a little bit of a lower open. We went all the way down to the pivot level and didn't even make it down to S1, but we set up a bit of a base here. And then we came back above the pivot and actually then started to go positive. We made it all the way up to R1. That was acting a little bit as resistance. We didn't quite get up that far, but then we were even able to break above R1, and we closed just about at the high on the day. So think about this. We're in a recession. We're in a high inflationary environment, but the stock market is now looking more positive and starting to go up. You have the bond market looking a little bit better, and interest rates are starting to come down. That kind of goes counterintuitive to what you would think. That's why we have to look at these charts to try to tell us what's really going on. Now, let me go through and look at some of these other charts, and this should have been bigger. I'm not quite sure why it's not, but this is the different areas that I follow during the day. And this is the closing basis, where the large cap on the top, either the value, the core, or the growth. The two areas that I look at are the value on the left, and that was up strong, and growth was up even stronger. So that helps to feed more into the scenarios that we're looking at, that we're seeing more of a rotation from value more back into growth. And I have those charts to also show you. I do keep an eye on the mid caps and the small caps, and they're also outperforming growth right now. Even though both were up, we're looking at a comparative measure between the two. On a down day, we look to see, okay, which one is down more, which one is down less, and the one that's down less is actually outperforming. I hope that makes sense. I haven't shown this chart in a while. This is our ADX, where we're starting to cross back over with the black line, but we're still below 20. The green line is on top. So now we're starting to default to a positive trend. Then here's the daily chart showing that we did see a little pickup again in the volume. We're slightly above average, and we're coming back, and we've been able to break above, and what we say is fill this gap right here. So that's quite positive, at least looking at this chart right now. We still have overhead resistance. Here's a pivot level. Here's this long-term support, which I don't have the line going all the way across, but we're actually slightly above that now. So this is looking a lot better right now. Doesn't mean we're going to go up straight or go straight up from here. And we could always turn around and start to head back down, because we've been faked out before. But if we look at what's happening on the charts and then look underneath of what's happening, yeah, things are really starting to show some improvement. Then this is also a bit of a concern. I brought this up in yesterday's short video, where the Swinland trading oscillator, it's starting to turn up a little bit based on price, but still pretty much declining based on volume. So this is a little bit concerning, but hasn't really come over into price yet. Then here's our moving averages. We're not only above the 20 and the 50 now, we're starting to go back and deal with the 100-day moving average, which this is the exponential 100 period moving average. So this right now might be acting as resistance. Can we break through and get to the simple moving average? So it's kind of nice to be seeing moving averages again in the daily charts. This, and I have to make this a little bit bigger too, this is a real mess of a chart. But when I talk about the different yield curves, this is a list of all the different ones that we have available to us. And I don't chart all these, I don't show them, because I try to focus on the ones that the market tends to focus on, which is the 10 to the 2. That's the 10-year to the 2-year. And then we have the 10-year to the 3-month. Those tend to be kind of the big ones. There's another one where it's the 10-year to the Fed funds rate, but that doesn't change all that much. So then we have to go in and look at futures contracts instead. And I do keep an eye on that, but that seems to be holding up. But this is just a kind of a conglomeration of all of the different yield curves. Now, if you want me to, I do have charts of all these other yield curves. If you want me to start bringing them up, I can easily do that. I'm trying to just show you the ones that most people are looking at. Then to look at some of our scenarios, this is the one scenario of those stocks that are above their 200-day simple moving average on a percentage basis. There's a little over 500 stocks in the S&P. So when a very few of those are above their moving average, the 200, this indicator really falls. When it's starting to go back up, that means that more and more percent of stocks in the S&P are starting to go above their 200-day simple moving average. And this continues to bounce up nicely, as we're now starting to at least see a little bit of confirmation with price. Here's the other charts. This is going into the 50-period moving average, where we were extreme negative and are bouncing up. That's in the S&P. Here's the mid caps also bouncing, and here's the small caps also bouncing back up. Then the next chart, this is our 5-period moving average of the equity put call ratio. We're still working off of this spike. And even though the equity put call ratio did advance slightly, which is kind of strange on an up day, but still, the market's still really unsure about things right now. We're still dropping overall. And so we're using this spike as kind of the benchmark. Can the S&P continue to go higher from this spike that we had a while back? Then here's our sector rotation. One thing that was kind of interesting, we didn't see the Qs or the NASDAQ really help out as far as growth on Thursday. It was still up, but it wasn't as up as much as some of the other areas of the market. So the Qs actually declined a little bit, but we're still above the moving average. Where discretionary, it's still showing a nice little rebound, as is growth versus value with the large caps. And then here's our second chart of that, showing how the different areas, large, mid, and small caps, continue to advance against the value area. The growth is going up. So that's why we're seeing the advances in the S&P right now, as long as the growth stocks continue to go higher. We're also looking at this. We're still looking at a little bit of a spike with the small caps. That's this red chart here. And this is a ratio of the small caps against the S&P 500. So when this goes up, that means the small caps are outperforming slightly. And sometimes that can help give us support, which it appears to be doing right now, to the green line here. And that is the S&P 500 by itself. Then here's some of the longer term moving averages. We've been able to get above the short term moving average rainbow tree. So now we're looking at the intermediate term. This is the 50 to 100 period moving average. So we're coming back up into that rainbow, which is showing an improvement. And then here's the longer term one, where we're still kind of at the underside, because we have anywhere from a 50 period to a 250 period simple moving average. So this is just showing that things could be improving. We're not seeing any rollover with the whole rainbow yet, but things are looking better right now. Here's the 100 period moving average, which we haven't talked about in months. We're coming right up to the underside, and I talked about this. This may be acting as resistance here. Can we get up to the simple moving average? Can we break above this pivot area right here? Now, looking at some correlations, we're seeing what I kind of had talked about a little bit, where can the bond prices and stocks start to go in the same direction? So if bond prices are going up, that means interest rates are going down, and that can also mean that the S&P is going up as well. They're moving more in the same direction. That's why we're seeing more of a negative correlation between the yield and the S&P 500. So that's starting to get a little bit stronger. We're also seeing the S&P to the 10-year correlation also starting to get a little bit stronger. So that means bond prices are going up and the S&P is going up right now. Here's the dollar. It's still also in a fairly strong inverse relationship. So keep an eye on bonds. If bond prices are going up and the S&P is going up, that means that relationship is still intact. If you see the dollar going down and the S&P going up, that means that they're moving in an inverse relationship right now. Then this other chart is the tech sector against the 10-year yield. This is where we're starting to hopefully see some strength coming back into the market. Tech is heavily growth, and we're seeing a little bit stronger inverse correlation between the tech sector going up and interest rates going down. We're a little bit toppy in some of our indicators, especially the short-term ones, the stochastics, the force index. It's a little bit toppy there. The percent B with the Bollinger Bands, the Williams percent R, the Stoke RSI, the usual suspects that bounce all over. And if we have an update, it's like they go overbought. They're getting a little toppy. I don't have those charts to show you, but looking back 10 periods, we're starting to get a little extreme positive with the rate of change. So again, we might be due for some kind of a sideways to slightly negative pullback. We're going to keep an eye on things. If things do start to go down, What's the intensity of that decline? Are people really using that to sell into strength that we're seeing right now? Or is it just kind of flittering around with not a lot of conviction? Then here's the Fibonacci level where we've been able to break above this longer term line that we've been really having some trouble with. We got above the two Fibonacci retracement levels that are on top of each other. Now we're starting to go above this 50% retracement from the all-time high. And right now we're actually slightly above that. So we're starting to break through some resistance and we're starting to fill some gaps that were causing some problems before. Can this continue? And then the last chart I have here is just our staples to S&P 500. This spike is still looking valid. Even though staples were up, the S&P was up more. So this spike looks to be valid, and this is starting to go down right now, which is providing some support for the S&P 500. Then I guess I have one more chart. Here's the yields, just showing, okay, high inflationary, we're in a recession, and interest rates are going down. The market has kind of dealt with a lot of this already, the situation that's now coming out in the headlines. And so a lot of times what we can see in this kind of an environment is when everybody starts to hear about it, it's old news to the stock market. And that's why we're seeing a real drop in interest rates and we're seeing some support coming into the stock market. So I hope you have a very good Friday. I hope you found this little short video useful. I'll do what I can over the weekend with the weekly video and the intermarket analysis videos. I will do something, but whether it will be a full-blown video like I had been doing in the past up until a few days ago, I'll just put together what I'm available to do and hopefully that will be helpful to you. So have a really good day and I'll talk to you again over the weekend.